Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host, Tim Miller. G'day, Tim. How are you?
Yeah, going pretty well, Aaron. How are you doing?
Not too bad, thank you. Well, we've recently seen the finalisation of a couple of important rulings that we've been following, fair to say, for some period of time. Today, we're going to delve into the finalised NALI ruling, non-arm's length expenses, which naturally invokes NALI. Non-arm's length income, and that LCR, Law Companion Ruling 2021/2, gives us now the guidance and framework, in essence, that deals with expenditure that is incurred or not incurred that relates to both general expenses and specific expenses. So, Tim, can I get you to just break that down a little further for our audience as a result of the finalised ruling that we've got in this space?
Yeah, and look, as the heading of the ruling would suggest, it's been a long journey, given that we're talking about legislation that was introduced to take effect from the 1st of July 2018. We then saw the first version of the finalised ruling released in 2019, but then 2021, obviously LCR 2021/2. But then what we also saw, because the legislation didn't pass, we saw the government positively tinkering with the non-arm's length expenditure based around general expense, where under the previous provisions and definitely under the previous ruling, if there was a nexus to all of the fund income, so when you had general fund expenses that weren't on an arm's length basis or not paid at all, they said that would tarnish the entirety of the income of the fund as non-arm's length income, which was hugely disproportionate to the issue, which is, maybe someone wasn't paying a couple of $1,000s in accounting fees or something, and would end up with their entire fund being taxed at 45%. Very bad outcome from a superannuation point of view. But what we saw then was the recognition of this by Treasury, and the final position, which was the 2 times expense factor that we ended up with as a multiple, where the maximum amount of NALI was ultimately going to be 2 times the unpaid expense, or 2 times the difference between commercial and uncommercial nature of the transaction. So far more proportionate to the issue at hand, where you're just paying non-arm's length income ultimately on the difference between what you should have paid from an expense point of view.
Yeah, and ultimately there are some really important distinctions here with the general expenses versus specific, which we'll get to the specific stuff shortly, because there are arrangements here that if you fall foul of these rules, the application of that in a particular year where you've got a non-arm's length component doesn't permanently taint the fund.
Yeah, that's right. And I think that's probably, again, it's a good thing. In an environment where we all think that the NALI rules have gone too far, in a sense that we felt that this was one of those typical walnut sledgehammer scenarios that didn't necessarily need rectifying. I mean, those historically of us contemplate that this is all linked back to interest rates and limited recourse borrowing arrangements, right? And so, okay, there is something to address. They've addressed it. And they've addressed it for general expenses. And yeah, by again changing it to the 2 times expense factor is a win, but also highlighting that if you rectify the situation, then you're limiting the NALI to the year of the breach, and then there's no more tarnishing moving forward, which of course is in direct conflict with the rule that hasn't changed throughout the whole period of time, and that is specific fund expenses. So if you have an expense, a non-arm's length expense linked to a specific asset of the fund, then not only are you tarnishing the income of the generated by that asset in the year, but you're actually tarnishing that asset effectively in perpetuity, so forever, as a non-arm's length asset, which then will tarnish capital gains and other things. And so very disproportionate. And they're the areas that we still think could do with some tinkering. But whether the government is willing to listen is another issue.
Yeah, and that whole concept of NALI being invoked by unintended or minor expenditure that's been incurred is still that, I guess, that area that we don't have a satisfactory outcome. We don't have a safe harbor. We don't have a de minimis that really allows us to work through that. Whereas if you look at it in the general expenses context, it's kind of, you did the wrong thing here, pay your penance, which is in essence a 2 times multiple of the difference, and broadly, fix it and move on. And there's the importance on that side of the ledger to look at things like getting discount policies in place. And there has been some clarity in this finalised ruling around the fact that there's nothing wrong with those discount policies. Just make sure that they stack up commercially, that they're enforceable, and that it's not kind of being massaged to suit the narrative of the transaction there. So the arm's length or commerciality of that arrangement is really important. The other one, Tim, there that I find, or that got tidied up, I guess, is just looking at with the expenses, is the articulation within the ruling quite trivial in terms of how they've done it, but just to understand that you actually need a connection of the expense to income to be able to invoke NALI. And what I mean by that is you're looking at the principles within 8.1, so a deduction that is incurred that would ordinarily derive income within the fund. So you could have the fund administration cost, it could be advisor fees in respect to it. But then we have a whole range of other expenses that are incurred within the fund, such as the lodgement of the tax return, the preparation of the actuarial certificate, the preparation of the audit. So those items aren't ordinarily linked and therefore deductible under 8.1. They are specifically driven expenses under 25.5 that we have now seen clarification within this ruling that says if those expenses are not incurred in a commercial sense, you cannot enliven the arrangement in essence from a NALI point of view, because of the fact that the way in which these rules operate is you must incur the expense that would be otherwise deductible, that would be deductible and connected by virtue of Section 8.1.
Yeah, and look, it's, to me, and having that distinction is great, but I also think, are we then creating a rod for our own back again, in the sense that how many people distinguish between tax agent lodgement fees versus fund administration fees and things, and how is that going to play out? So you can see what they're trying to achieve by that, and also how much of this is actually ever going to be targeted. That's always been the great uncertainty for all of us, is that are we spending a lot of time? We've wasted 8 years of our lives talking about it. Not that we've ever wasted any of our lives talking to people about legislative changes, Aaron, but it seems a lot of conversation around NALI for something that may not necessarily be dealt with a lot.
Yeah, well, we used I vividly remember the slide at our events 2 years ago around is this a mountain or a molehill?
Yeah,
and it goes very much to your comment, and the quantum of what the ATO will potentially recover through this is going to be quite minuscule. We've seen a new example within the ruling that is meant to provide us with some additional guidance, but I mean the reality is that it doesn't really give us much at all. So there's this example in 7A that's been added where Mina, she's a chartered accountant, she operates her accounting service, but she gets a phone call from the auditor, which in essence is a work phone, and she takes it during business hours, and there's a request for some information. So she desires after the phone call to use a work email address to send her the information on the work computer to be able to do it. Now, they say, well, she's performing those duties in her trustee capacity, and therefore, fine, nothing to see, it's not going to invoke NALI. Now, the auditor's never going to be asking, oh, well, actually, did you send that on? And why are you, where's your other phone that actually is your trustee phone number as opposed to your work phone? So it's really trivial. And that's the concern, I guess, with some of these examples, that they're not really reflective of what I think the industry would benefit from. And we've seen a couple of PBRs that I think provide a much more meat on the bone compared to something like that. But that to me is probably one of the most disappointing aspects that's come out of that ruling.
Yeah, look, and I mean, it's not like us to draw attention to some of the examples that are used that ultimately don't relate to the rest of the way that we operate. I mean, because how many auditors use telephones? I mean, everything's through a workflow, so she doesn't need to go then and do an email because it's probably already come via some form of email notification. But no, you're right, and I think even the examples that they utilise of Tran, the plumber, and other things. There's a bit you can take out of there, but then there's also it poses so many other questions, and I think that's the issue. That whole individual versus trustee capacity is still really, for me, debatable as to under what capacity, because overlying all this is 17B and the whole remuneration piece, and so some people are going to be caught between a rock and a hard place and not necessarily know what to do, and it could result in NALI for no real reason.
Yeah. So this is finalised, but is it resolved? I guess is the question.
No, it's definitely not. Look, I think it's resolved in the sense that do we just move on and assume that it's going to impact very few people versus specific expenses, which of course will impact a lot more people. Do we kind of just have to go, well, there's bigger fish to fry. Let's still operate in a NALI environment that we always have, like understanding the whole arm's length nature of transactions can impact things, because that is where there is far more revenue at stake for clients. And really just, look, I think what it does in simple terms is it addresses the need of ensuring trustees think about what they're doing from a transactional point of view. So if anything, it sort of sharpens the pencil a little bit around, what your obligations are as trustee to act responsibly.
Yeah, and to that point, I think as well that the ATO's had opportunities and the industry's requested, de minimis and other forms of relief, if you want to call it that. And really, the ATO has stood quite firm in it to say our job is ultimately to administer the law the way that the law has been drafted. And it appears that that's kind of the stake in the ground that they've done. And again, it seems to be consistent with some of the other rulings that they've finalised in recent times as well.
Yeah, and probably my full stop on this is that, and your comment there is spot on about the ATO saying they're administering the law. I think the NALI one, they maybe took a few liberties in how they interpret the law. Obviously, where they have directly interpreted the law is the CGT link with NALI. And I think that, we can accept that the ATO going, we're just interpreting the law in front of us. And they go, yes, but now with this law, there's an inequity with regards to gains that shouldn't be tarnished with NALI actually being tarnished with NALI. And maybe that's something that Treasury need to look to address next. So hopefully it's actually not the end of NALI, because potentially we get these other areas looked at.
Well, if we do, then there'll naturally be a conversation that we'll have at some point in the future on feeling smarter. But once again, Tim, thanks for your time.
Always a pleasure.
Excellent. Thanks, everyone. Have a great rest of the week. See you soon. Bye for now.
Bye.